I'm going to take you through the outlook for the public finances and some of the key risks to the path that we forecast. To contextualize what I'm going to present, let's first take a look back. In this chart, you can see total public sector spending by the UK government over the past 2 decades. And we can see that quite a lot has happened over these past 2 decades. We can clearly see a peak during the financial crisis and associated recession. And we can see the effects of austerity as we've slowly brought total spending back down to what it was before the crisis. On the other hand, total revenues, these are both tax and non-tax revenues, have been much more stable. But they have been edging up ever so slightly and actually currently, or in the last financial year, make up the highest proportion of national income that they have since about the mid-80s. So the gap between those two lines is a key measure of interest for us. This is public sector borrowing. And you can see that this gap has been narrowing since its peak during the financial crisis and is still some way off of being closed entirely. However, if we focus just on current spending, that is day-to-day spending excluding investment spending, then in the last financial year, actually for the first time in 17 years, the UK government has run a current budget surplus. Or in other words, the government has managed to pay for all its day-to-day spending with the revenues it has raised in the same year. So let's pull out the deficit a little more clearly. Again, the same pattern that you could already see from spending and revenues in the previous slide, a peak during the financial crisis, and the government bringing the deficit way down since then. And in the last financial year, actually, the deficit was at its long-run pre-crisis average as a share of national income. That is just under 2%, about 1.9%. Now, this might lead you to think that the crisis is now a distant memory in the public finances. However, these large deficits that we ran during the crisis and in the immediate aftermath have left a mark on the stock of debt that we've accumulated. And if we bring up public sector net debt on a separate axis, so this is to be read on the right-hand axis, then we can see that even though debt has started to stabilize as a share of national income and in the last couple of years actually started to fall, it still is at above 80%, and that is more than twice the level it was at before the crisis. Now, what does this mean for the government's fiscal targets? In the 2017 elections, the Conservative Party manifesto included a commitment to balance the budget, to eliminate the deficit, by the mid-2020s. Now, we think that it's fairly clear from their behavior that neither this government nor its predecessor were seriously aiming at achieving that target. So we're pretty much discarding it from our analysis, and it doesn't seem to be guiding anybody's behavior. That leaves us with 3 targets. And the most constraining one of these is the fiscal mandate. And the fiscal mandate states that the cyclically adjusted deficit, that's borrowing, but corrected for temporary ups and downs of the economic cycle, should be below 2% of national income in 2020-21, so the next financial year. And the 2 other targets are targets on debt, the supplementary debt target, and the welfare cap, but I won't be focusing on these 2 now. So back in March, when the OBR last made a forecast for borrowing, it said that it expected borrowing to come in at around 21 billion, below 1% of national income in 2020-21, the relevant year for the fiscal mandate. And it also said that it expected cyclically adjusted borrowing to be at 19 billion. So these 2 numbers are quite close together, which means that the OBR expected the economy to be operating at close to capacity in that year. Now, I mentioned before that the ceiling that the fiscal mandate places on cyclically adjusted borrowing is 2% of national income. In cash terms, that would come to about 46 billion, which gives us quite a good picture, right? It looks like the government should have 27 billion of headroom against this target, which looks quite comfortable. Now, this is what has been called the headroom or the Brexit war chest, depending on who you speak to. Now, a lot has happened since March, not least for the public finances. And one of the things that have changed since then that we already knew about at the time is an important change to the way that the Office for National Statistics accounts for student loans. And loosely speaking, under the new accounting treatment, when the government loans a student some money but doesn't expect to get that money back, then that money is counted as public spending from the beginning, from the moment that it is loaned, as opposed to 30 years later when the loan is actually written off. Now, because this more accurately reflects the economic reality, we welcome this change, but it does eat up about half the headroom we seemed to have back in March against the fiscal mandate ceiling, adding 14 billion to the deficit. Another thing that's happened since March is the September spending round, when the new Chancellor Sajid Javid announced a substantial fiscal loosening. You'll be hearing a lot more about recent top-ups to spending plans in Ben's presentation, but for now, it's enough to just say that he pretty much used up every penny of remaining headroom he had after the student loan change. And then we had another little surprise in September, just a couple of weeks ago, when the Office for National Statistics published its September public sector finance release, in which it had uncovered an error in the way that HMRC had been reporting corporation tax receipts, and also improved its methodology for accounting for public sector pensions. And the combination of these two changes could be expected to add around 4 billion to borrowing in 2020-21. So where does this leave us? Well, we could easily expect borrowing to be at around 50 billion in 2020-21, cyclically adjusted, which means that we would have a 4.5, almost 5 billion overrun over the target, the ceiling that the fiscal mandate sets us. So, moving on to a more medium-term analysis, we adjust our forecast for all the things I've just explained about the student loan change and the spending round. And in addition to that, we use the latest growth forecast from the Bank of England, which projects weaker growth in the near term and then some pickup, some recovery in the later years of the forecast. We also include a temporary boost to growth, which feeds through into a boost to revenues from the spending round giveaway. And we include a direct fiscal saving from lower EU transfers after replacing EU spending in the UK. We assume that this direct fiscal saving is banked or is available to fund other spending. And we also include departmental spending growth beyond 2020-21, sufficient to cover pledges or multi-year spending settlements on the NHS and schools. Now, what we don't do is we don't adjust for strong growth in borrowing since March. This is because the growth in borrowing since March that has come in is mostly driven by higher spending, which may not persist until the end of this financial year, much less the next one. And we also have not included any tax cuts or any additional spending beyond these limited things that I mentioned, so the spending round, the NHS and schools. This leaves us with this medium-term forecast for borrowing. So we would expect borrowing to come, headline borrowing, no cyclical adjustment, to come in at about 55 billion this year and 52 billion in the next year, and then settling in at a level of just under 2% of national income after that. Now, average GDP growth with this adjustment from the Bank of England could be expected to be really quite weak at 1.3% on average in this financial year and next. However, this is the smooth and orderly Brexit scenario. This is based on the OBR's central forecast, so this is, in some sense, a good world to be in. And what happens if we instead look at a no-deal Brexit? I should stress that what we've modeled here is a fairly benign no-deal scenario, if there is such a thing. This is based on the IMF scenario, which the OBR also analyzed over the summer. And this assumes that the immediate disruption is kept to a minimum, that there's some cooperation. You might call this a managed no deal. It assumes that trade barriers come in gradually rather than all of a sudden at the moment we leave. So nevertheless, even though this is a benign scenario, average GDP growth in the first 2 years is negative at minus 0.3%. And there is a massive increase to borrowing. So at the peak in 2021-22, we could expect to borrow 49 billion in addition to what we were in the baseline scenario. Now, we've seen that we can't really expect to be meeting the fiscal mandate next year, even with a smooth Brexit. If there's a no-deal Brexit, things look even more dire. Where does this leave us in terms of our fiscal targets? Well, all the current fiscal targets expire within the forecast period anyway. So we might think that it's time to set some new fiscal targets. And the budget, the first budget for the new Chancellor Sajid Javid, might seem like a good opportunity to set out the government's thinking on any new fiscal rules or targets. Now, just to remind ourselves, why do governments set fiscal targets in the first place? Well, they're essentially a self-commitment device. The hope is that we would be more credible to markets or to the outside world if we've committed to a certain fiscal position. And we might also expect a fiscal target to strengthen the Treasury's negotiating hand when it comes to negotiating a longer-term spending settlement in next year's spending review. However, there is a challenge in that targets that are flexible enough for a no-deal Brexit, that would allow the Chancellor to react and support the economy in that case, are almost inevitably going to be too loose for a smooth Brexit. So what we would recommend is to take some time and to set new targets once at least some of the Brexit uncertainty has been reduced. Otherwise, if we rush into new targets that will then join several other targets in history that have been either missed or abandoned, that really doesn't do anything for the credibility that fiscal targets are meant to foster. In the meantime, a thing that the Chancellor might consider to still provide some sort of a fiscal anchor is to commit to not making the problem worse by limiting permanent increases in net day-to-day spending unless they're funded by tax increases. Now, that would leave him some room to maneuver on both investment and any temporary fiscal stimulus. These are two types of spending where we might be more relaxed about borrowing. And this is something to also keep in mind as and when we do actually design new fiscal targets. And the reasons for that are that if we borrow to invest, then we might borrow and leave future generations with some debt, but also leave them with some assets on the other side of the equation. If we make good investments, then that might improve future quality of life, that might raise future economic growth, then we would have something to leave future generations to benefit from. Now, especially if you're, for example, the Labour Party and are considering a large increase in the size of the public sector balance sheet overall, you might want to have a fiscal target that targets a measure that considers public sector assets as well as liabilities. Such a measure already exists. We could, for example, target public sector net worth instead of debt. Now, this is certainly something that deserves more consideration, but we would warn that there's reasons to be concerned about measuring public sector assets in a transparent and credible way. So this measure would require us to, for example, value the road network, both today and in the future, or the broadband network, and any number of other physical and financial and non-financial assets. Now, if these measurements were to move from year to year, for example, when the methodology is changed, then it could be difficult to make this target as credible as a net debt target can be. The other reason why we might want to allow more borrowing is during a temporary downturn. Now, borrowing goes up automatically during downturns because we have a progressive tax and benefit system, and therefore the automatic stabilizers increase borrowing during a recession. But especially when monetary policy is ineffective, we might think that that's not enough, and that actually what we want is a discretionary fiscal stimulus. Now, if we do decide that this is something we want to do, then there are three key considerations. One, we would need to get the stimulus out the door quickly. We would want it to be targeted to the regions, the industries, or the individuals with the greatest cost of lost output. And crucially, we would want it to be temporary to restore fiscal sustainability in the longer term. This is because in most recessions, and especially in the one that I'm going to talk about, one induced by a no-deal Brexit, they would involve some re-evaluation of the path of the economy in the longer term, and a smaller economy can't sustain the same level of tax and spending as the economy we were previously expecting. Now, in the short to medium term, there would therefore be a case for a temporary stimulus package after a no-deal Brexit. We've modeled an illustrative scenario of 1% of national income. We've assumed that this stimulus is implemented next year immediately and in full, so it succeeds in being timely, and it is withdrawn after 2 years, so it succeeds in being temporary. And in the longer term, however, higher trade barriers and, to a lesser extent, lower net migration will lead to a smaller economy, and this smaller economy would require either higher taxes or lower spending on public services. So there's obviously loads of uncertainty around these scenarios, but for example, the IMF benign no-deal scenario that we use, in the long run, would require an additional fiscal tightening of 1.5% of GDP. That's 33 billion in today's cash terms. Now, this is the slide I showed you before, what happens in a no-deal Brexit. Now, if we implement our illustrative stimulus, then we get into this situation. Now, we have some extra borrowing. You'll notice that the extra borrowing is less than 1%. That is because the stimulus works and generates extra growth, which feeds back into extra revenues. So part of the stimulus pays for itself, but not all of it. And the success of another measure of the success of the stimulus would be that it brings up average growth in national income in those first 2 years to plus 0.2%. So what does this mean for debt? Well, there's obviously a big effect of having a no deal at all. You saw the borrowing figures, and they add up to a substantial amount of extra debt at the end of the forecast. But in comparison to that, the effect of a stimulus, if indeed it succeeds in being timely, temporary, and targeted, is much smaller than that, and we might well decide that it's worth it. Now, I should stress that we've assumed a size of 1%. For example, Christian and Ben, I think, have assumed something closer to 2%, so you might need to scale that up. Even though the stimulus would have a small effect, debt in either of the no-deal scenarios, with or without a stimulus, would reach its highest level since about the mid-1960s. And in this graph, I've shown you debt excluding the balance sheet of the Bank of England. It's not so much our core business to model what the Bank of England might decide to do, but depending on their policy action, headline debt might increase much further. Now, what does the long-run outlook look like for public sector net debt? Now, remember that in our baseline case with a smooth and orderly Brexit, I showed you that in the last 3 years of the forecast, the deficit would come in at just under 2% of national income. Now, one thing we might think about is, well, what would happen if we just did that forevermore into the future? And that's what I'm showing you in this graph. And well, since we don't have a fiscal target, it's not really clear what we should judge this against. But if at the most basic level we just want debt to not be explosive, to not be growing and growing, then this looks like fairly good news. If, on the other hand, we want to get back to the levels we saw before the crisis, we would have to wait quite a long time for that. Nevertheless, even this path might be difficult to achieve since it requires keeping this deficit that we're running all the way into the future. So I've already talked about the long-run consequences of a no-deal Brexit, and I've already mentioned that we could expect about 1.5% of national income of an increase to borrowing if we would need to accommodate this without tax rises or cuts to other spending. Even if we do think we're going to get a deal, then the next recession might not be far away. So experience suggests that the UK economy suffers a recession about once every decade. And put this in inverted commas because there's not really any such thing as a typical recession, but the average recession before the Great One, so the recessions in the 70s, 80s, and 90s, added about 1.75% of national income to borrowing for 2 years. So that would be a significant threat to our below 2% target. And finally, this is an issue that we've not been hearing much about recently, but that is going to grow ever more pressing. There are significant increases in demand for healthcare from within the healthcare system and due to an aging society, to social care and to pensions. And the OBR has forecast that we could expect an increase of about 2% every decade. So we would add 2% to yearly borrowing every decade if we were to accommodate these spending pressures without raising taxes. So in combination, these pressures suggest that keeping the deficit below 2% might be quite an illusion. And what we take away from this is that this is really not the moment for any substantial and permanent net tax cuts. This brings me to the end of my presentation. I've shown you that the outlook for borrowing has worsened dramatically since March, and that the government is now on course to breach its fiscal mandate. This is more likely than not. I've shown you that even a benign no-deal Brexit scenario would have a substantial impact on the public finances. There would be a case for short-term stimulus, but in the long run, we would probably require more austerity, as in either lower spending or higher taxes in the smaller economy that we would be left with after a no deal. And I've discussed that fiscal policy is currently without any credible fiscal anchor, but that we may want to wait in setting new fiscal targets, and that there are major risks to the long-term sustainability of the public finances, chiefly from health and social care, from pensions, and from future economic growth and future recessions. I'll now hand over to Ben, who will tell you more about the spending sides of things. Thank you very much.